Start with the
उद्योगपति की श्रेणी में आना है, नौकरी की श्रेणी छोड़कर उद्योगपति की श्रेणी में आना है, सैलरी को छोड़कर नौकरियों का बनना है, नौकरी की श्रेणी छोड़कर उद्योगपति की श्रेणी में आना है। इंडियन इकोनॉमी का मंत्र विकास है, MSME का है सपना, इकोनॉमी 5 ट्रिलियन छूनी है, मत की कमी सोचे सब MSME कहानी है, उद्योगपति की श्रेणी में आना है।
This is our anthem for the MSME industry. So this particular song has been coined by us itself, where the lyrics are by are made by Desai sir, Nilesh Desai sir. His own has sung the song actually. So we'll go with the next itself, and the topic is on finance, the pillar of strength, and it will be presented by Desai sir. Before going on with the presentation, I would like to introduce Mr. Nilesh Desai sir. He is the founder and CEO of SME Analytics. He is an MSME expert and is the author of the book The Unexpected Gold Mine: The Opportunities in the Revival of the Sick MSMEs. He is fond of writing daily newsletters to spread awareness about the MSME world. Mr. Desai has a vast experience in the engineering industry. Mr. Desai has widespread knowledge in MSMEs towards increasing the operational efficiency of the MSME units. He is a member in various companies and represents the interest of MSME. He has traveled extensively and has business associations in Australia. So, thank you once again for joining in large numbers. Desai sir, please carry on with the presentation. Thank you.
Good evening, everybody. Today's topic is very critical to MSME, and the name of the topic, Finance, the Pillar of Strength. So I'll try to introduce the importance of financial planning, which is required to be done by any MSME unit. The financial plan is very important for the long-term growth of our MSME. The small and medium enterprises are usually occupied with day-to-day objective activities, and they rarely get time for planning long-term goals. However, for day-to-day survival, finances are the most important thing. Starting with a business plan and project report, it has some steps which everyone should be focused into. See, this is very critical. See, you should have a clarity of thoughts and ultimate goals in your mind. So a plan and a project report. Project report will try to give you a broader picture, and with that you can start detailing out. So it is these are the steps which I am going to read now. Let's look at the steps one by one. Problem statement. Generally, either you say problem statement or market requirement. What is the source of problem customer is facing? If you if you try to focus on the pain points of the customer and giving a solution, it will help you to work out backward and give you strength for where you can start. Search of solution. Brainstorm the various solutions and evaluate the best. Once you come out, you will come out a sketch idea of the idea what you can do and execution of the solution. How are you going to execute that? Search for key partners and suppliers. Key resources required for development of product and services, marketing and distribution channel, customer segmentation. The last point, risk analysis of competitor, buyers, cost, new entrants, revenue stream, etc., gives you a firm idea about the what exactly you are going to do. Next, please. Next slide, please. Then basically you start working on a small sort of a budget preparation. It is necessary for MSME to calculate their setup cost for number of reasons, like estimate their profits, do a break-even analysis, secure a loan or attract investors. This is very critical. Do a business startup budget plan. Start with the facility cost, which deals with location like rentals, purchase, fixed assets like that. See, whenever you want to start a manufacturing unit, you will be requiring a fixed assets. You will be requiring a furniture, tables, electrical facilities, etc. So as soon as you go working in deep every item, you will be able to arrive what is a fixed cost, how much money is required to set up the facility. Say when you count your say rentals, say I'll have to pay 10,000 rent or 20,000 rent, then you forget about a deposit which is required. When you work out for electrical wiring and other things, you may forget about the this deposit to be given. Now you'll have to take GST registration, various government compliances, all that costs are to be considered. Then you will be requiring working capital, that is materials and suppliers. Other costs like accounting, license permit, insurance fee, deposit, etc. Employees recruitment and HR costs. You'll be requiring people. So how are you going to hire your staff? What is required? Estimate monthly fixed and variable cost. Estimate monthly sales. Create a cash flow statement. Calculate projected balance sheet and profit and loss statement. Now, one more critical thing, while creating cash flow statement, also prepare free cash flow statement which gives better understanding, and free cash flow versus sales ratio for past 3 to 4 years will give you very good indication of growth. If this ratio is deteriorating, needs prompt correcting action, and all key people should sit and brainstorm for root cause analysis, which can be attributed by new technologies, cheaper product. This is actually suitable for units which are 5-7 years old. And if their sales are growing, it does not mean that you are doing good. See, that you'll have to understand, if you have to pay somebody, you need cash. Your profit cannot pay that. You should be clear that profit will not pay your dues, but cash will pay. So while calculating, you should work out cash flow cost, free cash flow most critically. This all, it is better that you try to do yourself, so and take help of professionals at latter, so that any miscalculation or any unforeseen things which a seasoned person, a mentor or a financial consultant or a experienced peer can help you to do this. So these are the things for budget preparation, which will give you a sketchy idea. Actually, budget preparation you should do as soon as you start your work every year, so that you can allocate the money for various expansion if you want to do, or corrections. Next slide, please. See, there is a very thin line between accounting and finance. There is a lot of big connection between these two. Accounting focuses on day-to-day flow of money in and out of a company or institution, which is recorded, whereas finance is a broader term for the management of assets and liabilities and the planning of future growth. See, account is generally past event which you have recorded for various statutory and standard accounting procedure. Accordingly, you will have to follow for government purposes, your internal purposes. So every rupee which you have paid today, from where it has come and where it has gone, is recorded. So this is accounting. But if you want to exercise optimal use of company's resources, see, you should understand what are the company's resources. It is fixed assets, it is intangible asset, brand value, all that resources. Then you will have to work out the finance. If you want to take detailed look at company's book to see the resources utilized, then you probably are more interested in accounting. Accounting is the organization and management of financial information, whereas finance is the management of money. Please understand this. Accounting is the organization and management of financial information, whereas finance is the management of money. It is often said that accounting looks back to company's past financial transaction, whereas finances look forward to plan future acquisition of assets. Accounting is more about accurate reporting of what has already happened and compliances with laws and standards. Finance is about looking up forward and growing a pot of money or mitigating losses. Finance seeks to understand financial data through the lens of growth and strategy. Finance will typically lead the annual budgeting and help entrepreneur and its team to take strategic decision for capital investment and financing. As you grow, technology may change, or software may change, and you will have to acquire that. Next slide, please. Now, before going to the types of finances for MSME, I would like to explain that generally there will be equity and a debt. These types of finances may come in the debt side. Equity side, I'll try to insist first. Equity is the fund which is required by the entrepreneur to bring into run the business smoothly, and generally for MSME, debt to equity ratio is 3:1, which was decided in the early evolution of MSME financing by RBI in India. It varies from countries to countries, but in India it is 3:1. But I will strongly recommend to new entrepreneurs to increase this to 2:1, or better 1.5 to 1 over a span of time, say 3 to 5 years of operation. This will give leverage to the entrepreneur to face uncertain events like Corona or any other unfortunate event. This is, if your debt equity ratio is low, then there is a possibility of leveraging this for a debt when you require all of a sudden, like we had a lockdown, or say sometimes it is earthquake, like in Kutch it has happened in 2000, in year 2000. So this equity to debt has a definite relationship, and generally our MSME entrepreneurs from nationalization of the bank in 1969, there were various strategies given by various professional friends, and which has created underutilization of MSME, and many MSME unit has become sick or weak because of those kind of things. So please take care that your debt equity ratio, equity is your own funds. If you borrow from your friends and relatives and bring in your book, you will have to service that uh, debt. It's a debt. So don't try to go create your own money or take subordinate debt kind of things. Suppose if you borrow from your father or your wife, which you don't have to pay 5-7 years, uh, till 5-7 years, then definitely your strength will increase. That will build, like in our corona, we were told to increase our body immunity. This will create this will give a good immunity, financial immunity to your unit. Generally, then I'll come back to debt side. You will be requiring a fixed uh, term loan, or you will be requiring a working capital loan whenever you want to finance your fixed capital, fixed assets. You will have to plan to borrow a long term, 3 years, 7 years, 10 years, depending on your cash generation in future, and give a projection to either if you are borrowing from banks or NBFC or wherever you are borrowing, you should project your cash flow in such a way that your cash generated in the unit is good enough to pay that payment, that installment in due date. See, please understand, slowly fintech industries are growing very fast everywhere in the world, and credit ratings are very critical. And apart from normal credit rating given by CBIL and other things, a lot of fintech has come out with various other methodologies, but more particularly to include unbanked entrepreneurs in the mainstream. So they give small loan, try to create a history, credit transaction history, and this is a new type of this thing phenomenon happening for last 4-5 years because of fintech industry, where the RBI is also supporting account aggregators and many type of things. They have created, first we had nationalized bank and cooperative bank. Now various small banks as well as only payment banks, a lot of financial instruments, sophisticated instruments, and interest are getting RBI, are getting done, permitted by RBI. So working capital loan, a diverse range of fund and non-fund based working capital loans make it easier for MSME to finance their day-to-day operations. You also should understand uh, fund-based and non-fund-based limit. When you are giving a bank guarantee or a letter of credit, a bank is not getting the money immediately. But in case of eventuality, for some contractual reason, they will have to fund that. So that kind of facilities are reasonably easier to get depending on your credit history and repayment schedules and other things. And normal day-to-day running, you'll be requiring raw material, you'll be requiring to pay your employees electricity bill, rentals, and many monthly expenditures, while you may be supplying the material to large party who pays you in 120 days or 180 days. So there you will have to prepare your uh, uh, cash flow planning in such a way that you do not run short of working capital. Term loan, I already said, for very enterprise, government has come out with Mundra loan, and over a span of time in our banking history, development banks were created for big projects, and then the model changed, and now we have got CDB and IDBI. IDBI bank also has come up. So a lot of these intermediate institutions have been created to support MSME's growth. Next slide, please. Earlier one, profit and loss. Now, when you go for um, bank loan, they ask you for is the to be done entrepreneur, and it has to be submitted by to the bank. So CMA data is very critical, and generally the entrepreneur goes to the professionals to make it. But according to me, CMA data has to be prepared by entrepreneur himself and then take a help from professionals, because they will be able to better and create this thing, create a deeper understanding for entrepreneurs, because most of the entrepreneurs is early in 60s, 70s, 90s, they were technocrat coming out from colleges or diploma holders or like that, and they started. So they not have much knowledge of finance, but they had a deep knowledge of product development and other things. This is very critical. Credit monitoring arrangement or CMA data is the financial report used by lending institute to analyze the financial position of a company before lending of a project loan, term loan, or for working capital limit. The Reserve Bank of India has mandated all banks to ask for CMA for borrowers above certain limit. And CMA gives a financial blueprint of a company's performance year on year to determine the overall financial health, eligibility of loan, repayment capacity, etc. Borrower of the loan or prepare their own CMA data statement. The format of CMA data is generally fixed, and it contains preceding 2 years actual performance, ongoing year estimate figures, and next 2 years projection. So generally bank asks for 5 years this thing. So last 2 years, then they can work out what is your normal anticipated growth, and next 2 years, what are you projecting this year, next 2 years. So they give a fairly well idea whether you require a working capital kind of loan, or you will be taking some loan or term loan, which to finance some capital expenditure which has come because of the change in technology or expansion of the unit or whatever it is. It will also contain cash flow statement, ratio analysis, projected balance sheet, fund flow statement, and analysis of maximum permissible bank finance for working capital, which should not exceed 75%. Yesterday, I was participating in a webinar where there was a lot of discussion about this MPBF and how a retired executive director of Union Bank of India, United Bank of India, what was he doing while analyzing I have declared a Vijay Malaya kind of person, a willful defaulter, and that is giving that makes me to say that CMA data is your bloodline for your own benefit. Try to work out your own CMA data and then take advice from professionals. They will be, because they are not technologists. You are knowing your product, so you know what are the raw material inflation likely to be there, or market demand, how much it is increasing, or what kind of market expansion you are looking. Suppose if you want to open a branch, say from Hyderabad to say Mumbai, then Mumbai branch, how are you going to finance? How are you going to project? The sales immediately will not jump up if you open a branch, but fixed capital, fixed expenditure will definitely go up. So how are you projecting it? Whether you are putting a separate branch forecast and combining with it, overlapping, all that is very critical. So please make your assessment yourself before going to professionals. Professionals will help you. They will definitely handhold you for understanding that what banks are looking for or why banks are looking for. I will explain that in latter part of my this thing. Next, please. Profit and loss account. As business grows year on year, it becomes absolutely necessary for statutory requirement. Every business must have to prepare profit and loss. By this, eligible businessmen can file income tax return and then they can avail bank or NBFC loan if they are eligible. This can help them to 4-5 years projections. Also, the basic component of profit and loss are gross turnover, then direct expenses, gross profit, indirect expenses, not profits. All that will come in a balance sheet or in profit and loss statement. And once you make this profit and loss statement, you will be able to make balance sheet, which will be a picture of your assets and liabilities. Next slide, please. See, when you from profit and loss and last year's balance sheet, you will have to prepare this year's balance sheet. Understanding the balance sheet and profit and loss improves your understanding about various kind of growth possibilities. To improve their balance sheet on a regular basis, entrepreneur need to know what a balance sheet is and what it says. Balance sheet is a financial document generally prepared at the year end. Balance sheet gives an organized view of short-term debt, inventory, or service you purchase, accrued expenses such as wages to employees, taxes that will soon become due. Balance sheet also outlines loans, cash, land, uh, prepaid accounts, inventory, equipment, account receivable that still needs to be paid for. It is an important tool used by banks and BFC to understand the financial health and liquidity position of an entity. See, please do not start your thinking that I'll be taking a bank loan. Please understand that banks and NBFCs are not they are taking deposit from savers and giving you money. So recovery for them is important. But for us as a entrepreneur, we are worried about our financial health. So understanding the balance sheet of yours is your responsibility, and you can use bank money as a other tool or other tool which you use in your factory to leverage certain things. Looking at this item can help you determine which liabilities are a priority to take care of and which assets can be adjusted or collected to help your company's cash flow. In the business world, there are several helpful ratios that people use to determine a company's long-term profitability and short-term financial outlook, uh, which is which are found in balance sheet and profit and loss. So next slide, please. Balance sheet is the asset and liability total amount be equal because a balance sheet is prepared using double entry system of accounting, and this system serves as a kind of error detection system so that so the equation must be asset is equal to liabilities plus capital plus net profit. Assets are non-current assets, are long-term asset which will not be realized, settled within 12 months of the balance sheet date. Current assets are likely to be used up or converted into cash within one operating business cycle, which is usually 12 months. These are cash and cash equivalent, account receivables, prepaid expenses, inventory, etc. Liabilities, if the liability is expected to settle within a normal operating cycle or 12 months from the balance sheet date, these are account payable, uh, accrued expenses, short-term debt, etc. Non-current liabilities, meanwhile, represent what the company owes in a year or more time, which will not be repaid within 12 months. Capital is the fund invested in business by the owner of the business, and net profit defined as profit of the enterprise coming from profit and loss statement. There may be net loss also in the profit and loss statement. Next slide, please. Now, I'll be little selfish. I was an entrepreneur for 39 years and I had suffered major setbacks because of not understanding my own balance sheet. And your balance sheet is saying so many things loud and clear from profit and loss and other things, which generally in India, we had a black money flowing in the business early days. Now slowly it is reducing down because of demonetization and GST. The flexibility of that is reducing. So balance sheets are quality of balance sheet are improving. Today, if you go to any banks or financial institution or credit rating agency, a MSME entrepreneur is his balance sheet is looked by suspicious, very much suspicious. That is why government has asked audit report is submitted and other things over a span of last 10, 12, 15 years, so that the mindset of an entrepreneur can be changed. But your balance sheet gives various ratios, which is, and generally it is known as ratio analysis, and is quantitative method of gaining insight into company's liquidity, operational efficiency, ROI, and profitability by studying its financial statement. There are 52 ratios which comes out from any balance sheet and PLN statement. Some of the important ratios are explained below. Liquidity ratio, that is, one is current ratio, one is quick ratio, which this whether you are making loss or profit, but as far as you are able to meet your immediate cash requirement, paying the suppliers or dues, your current ratio there will be it is known as current ratio. In current ratio also, in liquidity ratio, current ratio and quick ratio, there are two subsectors. In this, generally our banks are happy if your current ratio is 1.33, but they will be also little 1.23, 1.25. They'll be happy but little suspicious. Leverage ratio. See, the debt service coverage ratio, once when you take a term loan, banks ask to give you fund flow statement or cash flow statement for next 7 years, or till the fixed loan is repaid. So that is coming under debt service coverage ratio. The bank looks into that. Then debt to asset ratio, interest coverage ratio, efficiency ratio, asset. These are very critical for banks' point of view, and this is very critical for entrepreneurs' point of view. The asset turnover ratio is an indicator of efficiency which the company is using its asset to generate revenue. The higher the asset turnover ratio, the more efficient a company is generating revenue from its asset and vice versa. Inventory turnover ratio is a ratio showing how many times a company has sold and replaced inventory during given period. It helps to make better decisions on pricing, manufacturing, marketing, and purchasing a new inventory. A low turnover implies weak sales or a possibly excess inventory, while high ratio implies either strong sales or inefficient inventory. These are very critical. Then account receivable turnover ratio shows how well a company uses and manages the credit takes extend to customer and how quickly that short-term debt is collected. The account payable turnover ratio shows how efficient the company is paying to its suppliers or it is meeting its own current liability, payment. Most of the MSME friends who are existing also, return on investment or return on equity, return on investment, all these kind of things, they are not aware. So return on asset, return on equity, all these are very critical ratios for anybody who is running a business. Generally today, my MSME friend in India, what they do, they go to chartered accountant and work out how that tax liability can be reduced, and with the same balance sheet, they go to the bank and ask for additional working capital. But both are dangerous, both unhealthy, both kills your long-term growth. Please understand that if you have generated 1 rupee, try to your capital base, or try to use that this thing. Don't try to cut the pay the income tax, so that if you pay higher tax, your credit rating and your possibility of raising short-term finance will increase considerably. So please understand this. Next slide, please. Next, please. Next. Intangible assets. This is again a very critical thing for all existing MSME under intangible assets. Intangible asset has no physical presence or improve a small business long-term worth. They have some value because a business has sole legal or intellectual right to them, and they can help buy back this thing. Intangible assets also improve the value of other assets, and it will create valuation for equity. Some of the items that are considered intangible assets are technology like technical manuals, engineering process, computer software, contracts, franchise license and permits, domain name, brand equity, trained and competent worker called workforce in place, intellectual property, specially created by individuals and protected by law, customer relationship. Say if some customer is buying repeatedly from you for 5 years, your value goes up. Employees contract, company's reputation including goodwill, trade secret, brand recognition, proprietary business processes, marketing and advertising campaigns and materials, location related assets like land, water and mineral rights. These are few I have mentioned, but these are very critical, and it has to be cultivated for a long-term growth of a business where the finances, your ability to raise finance at a cheaper cost will be possible. Suppose if many of my MSME friends who are in the turnover range of 15 to 20 crore rupees, they can always look for IPO on SME platform, which will give them access to cheaper fund, improved corporate governance, and create a long-term source of good talent. So I would advise units which are in the range of 15 to 20 crores for preparing for IPO. IPO will also help you for succession planning. See, if your children are not likely to join your business, they can be still a director, and it will help you to plan success. Succession planning, it will help you. Next, please. Next, please. So few problems which I have found out in my 45 years of long career. Many MSME entrepreneurs divert short-term fund for long-term use. Now they do not know what is a short-term fund and what is a long-term fund. So they divert. Today I've got 5 lakhs in this thing and I don't need for 3 months. And they start constructing their own house or this thing. And when some big order comes, they have to rush to the bank. This can be avoided if you don't divert your short-term fund, and if at all you require a asset to be purchased for this thing, either you go to your balance sheet strength or work out your cash flow and take a term loan rather than financing capital asset from short-term funds. Keep your short-term fund because cash is king. And if you have got a cash, you have got many advantages, like you can bargain with your suppliers to give you 3 to 4% extra discount. Or suppose if you have done this for many years and sometimes you come in short-term problem, the suppliers will bail you out. I have explained you various methods of financing, importance of cash flow, importance of balance sheet. Now I will coming back to next slide, please. Cash flow and fund flow. Next, please. Okay. Go earlier one. Earlier one. Cash flow, cash flow. Cash flow and fund flow. Cash flow statement is different from the income statement. This statement shows the inflow and outflow of actual cash or cash-like asset from its operational activities. Company receives inflow of cash revenue from selling goods providing services, selling assets, earning interest, rent, taking out loans, short-term borrowing, etc. Cash outflow can result from making purchases, paying back loans, expanding operations, paying salaries, etc. Cash flow statement is based on narrow concept. Cash flow, cash which is only one of its element of working capital, thus it shows the changes in cash, while the fund flow statement highlights the movement of cash only, that is, it reflects the net movement after examining inflows and outflows of monetary funds. The statement of fund flow was primarily used by accountant to report any changes in company's net working capital or the difference between assets and liabilities during a set period of time. Fund flow statement is based on broader concept, that is working capital, thus it shows the change in net working capital. Next slide, please. Next, budgeting. Budgeting is a basis for all business success. It helps with both planning and control of the finances of the business. Some entrepreneurs begin their operation with a wave of optimism and enthusiasm, but without a well thought out budget, they find it not possible to create a successful action plan. By referring to the budget, any entrepreneur can measure performance against expenditure and ensure that resources are available for initiatives that support the action plan. It enables the business owner to concentrate on cash flow, reducing costs, improving profit, and increasing return on investment. See, every entrepreneur is working for increasing its return on investment. Following a budget or spending plan will also keep you out of debt or help you work your way out of the debt if you are currently in debt. Budgeting for OPEX and budgeting for CAPEX, both are critical. Next slide, please. Next slide. Cleaning the balance sheet, which I would like to concentrate little bit. A clean balance sheet presents a clear picture of the company's assets and liabilities, not only to the entrepreneur, but to external stakeholders also. A clean balance sheet indicates a company has no significant debt during the statement period, allowing plenty of for financial flexibility to fund operations, meet financial obligations, or unexpected expenses. Companies with clean balance sheet will have a good asset coverage and liquidity ratio and low debt leverage ratio. And I have listed out various steps which entrepreneur can take. And because we are running short of time, I will go to one more facility which has been recently created last 3-4 years, is TradeX. TradeX is a game changer which will provide you short-term working capital against your receivables from a reputed big corporations who are having a good strong balance sheet. And because this finance is off your balance sheet, it can be a little cheaper, because banks whosoever have got short-term liquidity for 60 days, 90 days, they will be participating in auction day-to-day basis. And that is why since your working capital loan or your term loan can be at 7.9 to 7.9 to say 10%, while your bill discounting costs may be possible sometimes 7.5, 7.3, depends on the liquidity at that time, particularly in the market. So next, please. Recently, we have been awarded as one of the a 10 hottest startup in Hyderabad at Hysia, and it's a proud for me and my team for creating, including co-founders. Next slide, please. These are the activities which we do. One of the things which I would like to inform you is that we would like to develop a Z score, which is predictive analysis, a predictive insolvency indicator. That means if you are, or otherwise you can say free cash flow over a sales, which indicates that there is some weaknesses developing in your company, so that you can take prompt corrective action. Otherwise, these are all our standard services. We have got Babaji tool, which will help, which will analyze the balance sheet of MSME entrepreneurs free of cost and give you 52 variables. And if you give 3 years, you yourself will be able to understand how you have changed. And we also give a mentoring support for startups as well as MSME. Ours is a premium model. Next slide, please. This is our other services. More particularly, we can provide CFO kind of services, fundraising also, and IPO. This thing. This is our digital transformation support also we can provide. Next, please. I request everybody to subscribe to our YouTube channel, where you can get my old webinars as well as future one. This will be beneficial to all MSME entrepreneurs. Next, please. Thank you, everybody. Today, I'm very happy that about 100 participants were there, and it is good. Now we'll open up for question answer session for about 15 minutes. Vinaki?
Yes, sir. So we'll start off with the question answer session. It was a wonderful session. So many participants have joined. Thanks to all of you. So we'll start with the question. First question: many companies fail to survive. Is it because of poor financial planning, operational efficiency failure, or anything else?
See, generally, when you start a new unit and you are facing that problem of not performing well or this thing in first 3-4 years, it can be wrong product selection, it can be wrong technology, wrong financial tool, what you have used, or undercapitalize the unit, or the change in market scenario. Like see, today we are facing extreme problem because of COVID, of supply chain destruction all over the world. So there are many reasons, but as an individual, yes, if you don't take care of your finances and you don't see your ratios regularly, particularly a free cash flow, free cash to sales ratio, or many other fishbone diagram, or many other things are possible. So it is a very serious thing. You will have to look every regular time. You will have to understand your balance sheet and try to keep plan your cash budget and capex. See, many times you when you start, you have not estimated the market demand, and all of a sudden market demand is higher than what you anticipated. So you want to buy a bigger machine for particular production, and you divert that money from your current working capital. You are heading for a big problem. These are many things. So my book also, which is Unexplored Gold Mine, talks about some of these problems. Next, please.
Yeah. So next question is, how can a company show positive net income but go bankrupt?
See, again, come back that question, Pinaki.
How can a company show positive net income but still go bankrupt?
See, bankruptcy and good result has no immediate direct connection. See, if you do not have a cash to pay your suppliers or cash to pay your this thing, and definitely that affects your reputation, and that will drag you down. And when you do not have, you may have profit on your books. That profit is not cash. See, because that is lying somewhere either in assets or it is lying in receivables or many other things. So it is possible to go bankrupt with good company having a profit or good this thing. There is a good friend of mine, Mr. Hanumantu, also probably can give an answer. Hanumantu sir, would you like to answer? Okay, let us move to next.
What is the difference between cost accounting and costing?
See, for MSME entrepreneurs up to say 20, 30 crores, I would suggest not to bother about cost accounting and this thing. You should not go your own accountant with your chartered accountant or little professional advisor will be sufficing. See, if you complicate, see, my son used to say, uh, there should be no paralysis of analysis. So we should not go for too much analysis. Yes, when you grow, yes, when you have got capacities, right kind of team, then it is necessary. Otherwise, external professionals like chartered accountant and other people, they will be able to guide you better. Next, please.
How to avoid poor management of finance in MSME?
How to?
How to avoid poor management of finance in MSME?
If you are a technocrat, please tie up with a strong accountant who can give you a right picture. Learn from our Marwadi and Gujarati friends how they keep the accounts, their daily activities very liquid. You learn from them. Next, please.
What can I do to improve my finances in my company? Is taking short-term loan better or some long-term loan?
Do not think of short-term and long-term loan before you decide why that kind of money is, the situation has come. See, go to root cause analysis or five whys kind of analysis or fishbone analysis. Then only you do, or go for regression analysis. All this I am saying, as you go higher and higher, you will be able to understand. And I have already said, if you have diverted your short-term fund for long-term use, please borrow again on a long-term basis. Otherwise, today I borrowed a few lakhs today from the bank, which I think that I'll not be able to pay. And you made a temporary arrangement. You are definitely wasting your productive time uh, for unproductive work. Take help of chartered accountant or any professionals available so that who can help you to understand your problems and give you a reasonable long-term solution. Don't go with a short-term solution. It is going to be a killing this thing, and you will join the many sick units or weak units. Next, please.
Is debt finance better or equity?
It depends at what age of your this thing you are there, equity is generally better, but equity is very costly because dividend or this thing is coming after tax. So you will have to understand the finance mix, what is useful to suitable to your particular situation. Otherwise, normal course, if you are doing 1 crore, 2 crore business, equity, I will suggest a better, because you are in unknown trajectory till you stabilize. Once you stabilize, taking a debt may be a better thing, but it depends on situation to situation. Next, please.
Sir, that was the last question.
Okay. So can we tell what is the next webinar and when it is?
Yes, sir. The next webinar is on 26th Saturday, and the topic is precision of
Last chapter.
It's a very critical this thing, because as you there are a lot of startups who are working on valuation only, but similar thing is possible for MSME entrepreneurs also. So please join my next webinar on next Saturday 26 at 4 o'clock. Till that, see you. Good night or good afternoon in India. I am in Australia at this moment.
Good night,
Thank
everyone.